All right, well, the markets are absolutely freaking out today, so I thought what better day than today to make a two stocks I'm buying video. In reality, the best days to do that are when the markets are roaring higher because more people click your video, but I don't care. I go against the grain. This is why we've had so much success on this YouTube channel with the companies we buy and when we buy stocks. But today, the Nasdaq's down 2.4%. The markets have been highly volatile lately, and my poor small cap companies, this hurts, I must admit, they're down almost 3.5% on the day. And we have people like Meet Kevin saying that the pain in small caps is just getting started. And I want to make my point very clear today. I could not disagree more with that statement. I think now is the time to push that small cap buy button. You see, the market environment we've been in is one in which we were fearful about interest rates being higher for longer, which hurts small cap companies much more than it hurts the large cap companies. And we also have had recession fears everywhere. Even if they didn't make much sense, people were worried about a recession, and recessions impact small cap companies much more than they do the large cap companies. So for the longest time now, the two outcomes for small cap companies looked very unattractive, and that's why small caps have lagged so significantly over the past 2 or 3 years. But one thing that Meet Kevin is missing, and it's a very, very important point, his original tweet said, "Sorry, Tom Lee, rotating into small caps just as recession risks rise is fully," I'm not going to say that word, but what he's missing is our interest rate environment is entirely different than it's been for the last, 5-10 years, basically since the great financial crisis. Interest rates previously were at 0%. The Federal Reserve had zero room to cut rates if anything recessionary did in fact pop up. So his bias here is actually because of the experience he's had in the markets with interest rates near 0%, where it's very true. If recession risks rise, it's time to sell small caps. But you see, now is different. The Federal Reserve has successfully raised the federal funds rate to 5%. This is an entirely different environment where the Federal Reserve, if anything recessionary does pop up, has the room to cut rates. And they can cut those rates by up to 5% before having to send the federal funds rate into negative territory. This is an entirely different economic situation than we're in today. The Fed put is officially back and active. It protects investors from that downside recessionary risk, because I don't care what you say. If the Federal Reserve has room to cut rates by 5%, they have the ability in their pocket to be extremely stimulative to the economy if recessionary risks do pop up. Now, one thing a lot of people are pointing to is unemployment. They're saying because the unemployment rate continues to grind higher, a recession's knocking at our door. And they stopped their research there. But I'll give you the facts of the matter. The reason the unemployment rate is grinding slightly higher is actually primarily because of immigration. It's because of more and more people entering the workforce. It's not because employed people are losing their jobs. You can look at the insured unemployment rate. This will tell you if insured workers are losing their jobs. This unemployment rate is very, very low. It's basically at all-time lows. People that have jobs are not losing their jobs. The reason unemployment is grinding slightly higher is primarily because more and more people are entering the workforce, primarily as a result of increased immigration into the country. Now, I will concede that the labor market has been weakening. But what people don't realize is you can have a weakening labor market without it being recessionary. It can be a normalizing labor market. That's one of my favorite words, normalizing. Historically, a 4.1% unemployment rate is very, very low. And people are saying, well, this is how it always starts. Unemployment starts rising very, very slowly. Then all of a sudden it spikes higher. And that is so misguided because, again, today, these are dangerous words, but today is so much different than ever before in history. Where today, the Federal Reserve has successfully raised those interest rates to 5% without causing a credit crunch. Sure, we had a financial scare back in March of 2023, I think it was. Silicon Valley Bank failed along with a few other regional banks. Well, the Federal Reserve has learned how to basically play whack-a-mole with those issues. They formulate emergency liquidity facilities, and they contain those crisis events, and therefore they don't become economy-wide recessions. That's what's different today. The Federal Reserve has not caused a credit crunch that they've been unable to contain. And there's very little evidence that they're going to cause that. A 5% interest rate is normal historically. Before this 0% interest rate regime, like I just talked about, 5% was normal, and our economy and our companies performed just fine in that environment. I personally don't believe a 5% federal funds rate is restrictive. In fact, the only people really out there that are saying we need to cut rates now are the people that believe the only way the current bull market can continue is if rates get cut. That's their bias. And I'm permanently bullish. I think you're dumb if you're permanently bearish. But I will tell you that interest rates do not need to come down. Our economy is strong. Inflation is coming down. And we've proven that we can operate at interest rates of 5%. Sure, excess is being cut off, but that's a really good thing. We had a lot of excess formed because of the great virus crisis of 2021 and the bubble of that stock market. Now, just one more chart for you before I get into the two stocks I'm buying and really I'm kind of trying to go all in on. It's this one here. For the first time since 2021, small cap companies are set to outpace the earnings growth of both large caps and mid cap companies starting in Q1 of 2025. This is something that has not happened again since 2021. And in fact, during Q3 of this year, it's set to be the first time that small cap companies show positive earnings growth since the middle of 2022. It's no wonder that small cap stocks have felt pain, but really, Meet Kevin, now's the time to be bearish on these companies when the Fed put is active. Our economy is really healthy, and it's a known fact that interest rates are going to come down. I think that's the silliest thing ever. So it may not surprise you. My two stock picks today are going to be in the realm of small cap companies. I would even consider them micro cap companies. The fact of the matter is all small cap companies have been grouped together and punished the same, and that just isn't fair, and it's presented tremendous opportunity in small cap land to find companies with very healthy balance sheets, very healthy businesses, profitable businesses that have been punished just because they're a small cap company and they're supposed to feel pain because of interest rates or recessions maybe happening in the future. There are diamonds in the rough in this area, and I'm doing my best to put together an A-list of companies for my paid monthly members that I'm going to be buying, and all of them are in small cap territory. I've already released two of them, and in fact, those two are the ones I'm going to be talking about in today's video. But very, very soon, I'm going to be releasing number 3 and number 4. So if you want to get early access to that content, my price targets, etc., please feel free to join my membership by hitting the join button located right next to the subscribe button or hitting my Patreon link in the pinned comment. If you don't find alpha, if you don't get alpha in the stock market from my membership, I have a 100% refund policy. That's how confident I am in my membership and what I provide to my members. So yeah, it's risk-free to you. Join the membership. Anyways, my first stock pick I've talked about numerous times on this YouTube channel, but I still don't get it. This is so undervalued in my personal opinion that I just want to keep talking about it, and I still don't own as many shares as I want to. This is a $60 million company. Remember that. It's Flux Power. Ticker symbol FLUX. This is definitely a micro cap. It's technically a penny stock because its market cap is so small. But let me take you to the Yahoo Finance page and just give you a general breakdown of their financials. You can do this by going to the statistics page on Yahoo Finance. So in the last 12 months, Flux Power has done $64 million in revenue. And this is a $60 million company, okay? Sure, they're unprofitable, but I actually spoke to the management team personally, and I made a video about it to my paid monthly members. And the management team says they will be profitable and cash flow positive within the next 6 months. And this company is a company that actually was profitable on an adjusted EBITDA basis just a couple of quarters ago. But you all know that if you've been following my channel, you would know this. We've been going through a goods growth recession. There's been a rolling recession going through the goods sector of our economy, which has hurt Flux Power short term, but the long-term potential of the company is basically untapped. I'll show you why I like this company so much. First of all, they're a lithium-ion battery company. They provide lithium-ion battery packs to the material handling sector, so forklifts, warehouse robotics, also airport ground support equipment. There's a good chance if you've flown out of any major airport in the country, you actually have been around a Flux Power battery. Kind of cool to think about. They've shipped 23,000 battery packs throughout North America, and this is their customer list. This is the main reason I'm so excited. This is who they're selling these batteries to. Frito-Lay, Pepsi, Costco, Procter & Gamble, Walmart, Subaru, Caterpillar, Nissan, FedEx. The list goes on and on and on. Delta Airlines, Air Canada, United Airlines. They have, their customer base is Fortune 500, Fortune 100, and Fortune 50 companies. And you know what? Flux Power has been able to raise prices on these companies. Name me a single other company out there that has pricing power over the most powerful companies and the largest companies in the world. I'll wait. And this is a $60 million company total. And you can see these customers of Flux Power, they're seeking long-term relationships. Through the years, if they sign on new customers and these customers order from them, their orders actually tend to grow year by year by year because they're so impressed with what Flux Power provides. And they keep reordering. They order more and more, but it's obvious, right? If we're in a goods recession or a goods growth recession, obviously manufacturing is going to slow down a little bit, which means these manufacturing companies in particular, they're probably going to slow down capital investment spend. It just makes sense. But as soon as this rolling recession turns into a rolling recovery in the goods sector of our economy, Flux Power is going to benefit tremendously. They've made clear they have had 0 canceled orders. They have just had delayed orders. I actually think over the next 3-ish years, the company's going to more than double their current revenue. So I think they're going to be doing $140 million in revenue and plenty of net income and profit. And I actually have a price target spreadsheet. I'm not going to show it in this video because I've showed it several times. You can go back to my other Flux Power deep dives to go see that, or you can join the membership and download it. But this is a growing company with a very, very strong customer base. They have experience with some of the biggest companies in the world, and they can leverage that experience to sign on new customers. They just recently submitted a bid to the Department of Defense to provide batteries to the Department of Defense, which is another business vertical that this company will get into. But yeah, I just don't get it. A company like this that's going to be profitable within 6 months, and the stock market's saying this entire company is valued at $60 million. If you had $60 million, you could buy this entire company. And I probably would if I had $60 million, but I'm not quite there. Give me a few more years or hundreds of years. I don't know. But anyways, I don't really have that much more to share about this company. That's kind of the elevator pitch for the company. It's a really simple business model. I've mentioned all the things that are bullish. I honestly can't find many things that are bearish. They just hired an entire sales team. Previously, they only had 2 or 3 salespeople, and one of those salespeople was not functioning correctly or up to their standards, and they fired him, and now they've hired on several more salespersons. So future of this company is very bright, and if the markets don't want to own this company, I'll gladly take the shares that are available. Slowly. I wish I could win the lottery and purchase this company outright. But anyways, it's time for stock pick number 2, and this one is my second stock that I want to go all in on in the small cap and micro cap sector. I actually did talk about this company way back in 2021 if you go look at my old videos. But this company is so strong to me, and you'll see a lot of similarities to Flux Power with one-stop systems. This is a $45 million company, so it's even smaller than Flux Power, and I'll take you to their Yahoo Finance page. Over the last 12 months, One Stop Systems has done $56 million in revenue, so they too have exceeded their market cap in revenue over the last 12 months. They have had negative revenue growth, which a lot of people will stop their research there, but if you want to be successful in the stock market, you got to go a little deeper. This is actually manufactured revenue churn, or is churn the right word? I don't know. It's manufactured revenue reduction, where they were getting rid of one of their legacy customers that was a low margin customer. And they basically reset the entire business model away from that customer, and they're going after the much higher margin verticals of, I'll call it AI transportables. You see, a lot of the reason the stock market's actually struggled recently is because investors are starting to question the ROI on AI spend. And, companies like Google had bearish thoughts about it. Meta said they're not going to be profitable on their AI for years. I mean, they don't even have a timeline for it. So investors are starting to question, is this capital investment worth it if we're not going to make any money, or we're not going to be able to monetize our AI for years, if maybe not ever? So this really got me thinking. Voice crack, I've been talking too much. This really got me thinking about AI and its future. I don't think the AI that happens in remote data centers is really technically AI. We've had that around. It's been called big data in the past, but people think that AI is a much cooler buzzword for it, and people just go crazy when they hear AI. So we went from big data to AI. I don't think that companies are doing anything new or special if they're in that business, because when you really think about the future of AI and the potential for it, the growth in AI and the legitimacy of AI is going to come at the edge via mobile, ruggedized data centers. Think autonomous cars. This is the easiest example I can give you. With autonomous vehicles, autonomous driving is what they call it, where you don't have to have a person driving the vehicle. The vehicle drives itself. Is any amount of latency acceptable in that situation, where the car recognizes somebody all of a sudden crossing the road, maybe when they shouldn't be, and the vehicle has to send that data back to a remote data center for that data center to process the information just to send it back to the car? Any amount of latency in that situation is simply unacceptable. And that goes for really any of the verticals of AI that have a future, in my personal opinion. It's going to be on-site computations. It's going to be via mobile ruggedized data centers that are placed inside of those vehicles so that latency literally doesn't exist, or it's as very, very small or little as humanly possible. And that's exactly what this company does. So while this company is much more in its infancy than Flux Power, I still think Flux Power is really young, but One Stop Systems is certainly young, because a lot of the business verticals they're chasing after are in this AI transportables or AI on the edge applications. It's in that field. And I would encourage everybody to go to One Stop Systems investor relations page and just read through their news releases, read through the 10Qs, read through their most recent earnings report. I mean, it shows you what this company does. So if let's say you are worried about interest rates, let's say you are worried about recession, this company might be for you. This is a company that I think has been unduly punished, because much of their revenue comes from the Department of Defense or the US military, and also other international militaries. And also, you'll see they develop ruggedized liquid cooling for commercial autonomous truck customers. Things like this, AI on the edge. But because most of the company's revenue right now comes from the Department of Defense, the demand for their product is relatively inelastic, and it's insensitive to interest rates, because the US government and other governments around the world is the end buyer. Interest rates and recessions don't impact that buyer as much as it does the regular business or consumer. But if you do go read the company's most recent earnings release, they talk about a positive book-to-bill ratio of 1.1. Basically what that means is they've received more in orders than they've shipped out, which is a very, very good thing for the company. They expect that those positive order trends will continue throughout the rest of the year as their growing pipeline successfully converts to orders. So let's talk about the pipeline, because that's really exciting as well. The CEO of One Stop Systems says, "I'm extremely pleased with the progress we have made throughout my first year at OSS, as we have assembled a strong sales organization, expanded our 5-year unfactored pipeline to over $1 billion. So that's what I'm most excited about. Their 5-year unfactored pipeline is $1 billion. And again, this company was trading at what, $50 million, maybe less than that? I actually don't remember. It's just crazy, whatever it is. But they have an unfactored pipeline of over $1 billion. Let's say they actually capitalize, or they win 35% of that pipeline. That's $350 million of revenue over the next 5 years that the company will see. And again, this is a young industry. You'll see them talk about, I won't cover it here, or I won't show it. They talk about how a lot of what they're doing is actually customer-funded development into prototypes, where their customers pay them money to develop them prototypes. And that gets OSS in the door early, For whenever this AI trend really hits the ground running and these companies really spend a lot on it and really legitimizes itself, OSS is going to be, it's putting itself in the incumbent position. And with the high quality, custom designed and manufactured mobile data centers that OSS is giving its customers, that will make it very, very difficult for their customers to switch to a different supplier if a different supplier actually does present itself. And the CEO mentioned that they expect that customer-funded development number to actually grow. You can actually see, I'll pull it up, why not? Here you can see it on their income statement. They break down their revenue by product revenue and customer-funded development. He said that he expects this customer-funded development number to continue to grow and grow and grow quarter after quarter after quarter, alongside that positive book-to-bill ratio. And again, this company is so close to profitability, and much like Flux Power, they actually used to be profitable. And I expect that One Stop Systems will be profitable very, very soon, even despite this company being in such a young industry. And that's remarkable. If they're profitable now, think of how profitable they will be 10 years from now. Heck, even 5 years from now. It could be incredible the amount of return you see in a company like One Stop Systems. I'll briefly show you my price target spreadsheet here. This is all rough. It really remains to be seen how things really shape themselves out in this AI industry, but I have the company basically being break even next year in 2025. If I had to guess, they'll actually be profitable, but I like to be conservative with my price targets. And in 2026, I have them doing $2.5 million in net income. It could be much more than that. Again, it just remains to be seen. It's hard to really put a proper model on these young companies. But by 2034, and this could be low too, I could be way low, I could be way high. Depends how legitimate this AI space really plays out. I think it's legit. That's why I'm investing in this company. But by 2034, my conservative estimate is that the company will do $360 million in revenue and bring investors or shareholders over $90 million in net income, which is $4.35 of earnings per share. What this means is I think the company could reach a share price of over $100, well over $100 by the year 2034. Again, this could be way low and it could be high. It just depends how this plays out. But again, this is my conservative estimate. Doesn't mean I'm going to be right. But man, if you can buy the stock right now in the $2 range, what is it at? I don't even remember right now. I'll look on my phone. But if you can buy this stock at $2 or $3, I think it's in the twos. It is $2.17. You can buy this at $2.17, and over the next 10 years, if things really work out, the shares you buy today could be worth $130. That is a return over a 10-year span that you cannot find hardly anywhere. So again, these are kind of the diamonds in the rough that I've found, and I'm trying to buy as many shares as I can. But I actually have several more, and every day I'm doing more research into the small cap and micro cap sector, because I think that's where the opportunity is right now. These companies have been beat up for so long, and it's time for them to be leaders rather than laggards. And I think that's going to be the case. We know for a fact interest rates are going to come down. I disagree with the fact that they need to come down or they should come down, but the Federal Reserve has told us they're coming down, and I'm going to capitalize on that. I think Meet Kevin and all these other financial influencers are tremendously misguided if they think small caps are going to continue to underperform, especially when small cap earnings growth is expected to exceed mid caps and large caps over the coming years. I don't know, man. So I'm going to continue to post early access to these stock picks to my Discord members. I'm entirely self-funded, so your support every month means a lot to me. But just the fact you're watching this video and you're still watching this at what? We're really late into this video and you're still watching. I thank you so much. It means a lot to me that I get to do this every day. But yeah. With that, I hope you have a great rest of your day. I'm going to keep adding to my A-list of companies and sharing that information with my paid monthly members. If you don't want to pay for the membership, I'll try and keep you as updated as I can here on the public YouTube channel. It'll just be delayed information. But yeah, with that, I hope you have a great rest of your day. Stay blessed. Keep 10 toes to the ground and your chin up. Peace out.